Welcome, ladies and gentlemen. My name is Peter Youssef. Together we'll be going through a webinar about the week ahead in the FX markets. Before we start though, allow me to show you our risk warning and our disclaimer as you're reading. Now, with the Fed's and BOE's interest rate decisions already out and the release of the US employment report for October still pending, we have a sneak peek at what the coming week has in store for the markets. Now, despite the coming week expected to be more easygoing regarding financial releases, there are still some that could gather attention and prove market moving. Characteristically, we note the release on Sunday of China's trade data for October, while on Monday we get Eurozone's forward-looking Sendix index for November. On Tuesday we get Germany's CEF indicators for November, and on Wednesday we highlight the release of the US CPI rates for October. On Thursday we note the release of Australia's employment data for October, as well as UK's GDP rates for Q3 in September, while on Friday we get from the US the preliminary University of Michigan consumer sentiment for November. And with now no time to waste, we move to the US dollar, and this would be the USD index for our chart. Now, the index has been in an upward motion as it marks higher highs and higher lows. We tend to maintain that outlook for the index for the time being. However, we have to highlight that the upcoming release of the US employment report for October could substantially alter the index's direction. Now, nevertheless, to the upside, we tend to highlight the 94.60 as our first resistance line, which was approached a couple of times, specifically on the 12th and on the 12th of October and around the 28th of September. Higher than that would be the 95.10 and even higher the 95.70. To the downside, we note the 94.10, lower than that the 93.70, and even lower than that the 93.20. Moving now to USD's fundamentals. Now, on the monetary front, the view seems to be clearer after the Fed's interest rate decision. The bank, as was widely expected, remained on hold and announced the initiation of the tapering of its massive QE program. As was expected, the bank in its accompanying statement announced a monthly $15 billion reduction to its $120 billion USD monthly asset purchases. That's beginning this month in November, which should conclude the tapering and erase practically the purchases by near mid-2022. It should be noted though that the bank, especially Fed Chairman Powell, pushed back on the possibility of earlier rate hikes, and it's characteristic that the chairman said that the bank could be patient on the matter. Also in his opening statement, the Fed chairman said that the 4.8% unemployment rate practically understates the softness of joblessness due to low workforce participation, practically underscoring the bank's worries regarding the US employment market. Now, fundamentally, the next big issue for the US economy once October's employment report is out would be inflation. That's why we highlight the release of the US CPI rates for October on Wednesday, the 10th of November. Now, should the rates show an acceleration of inflationary pressures in the US economy, we may see the USD gaining, as it would imply an even greater pressure for the Fed to expedite the tapering and vice versa. Besides the CPI rates, we would also like to note the release of the PPI rates for October on Tuesday the 9th, the weekly initial jobless claims figure on Wednesday, and on Friday, the 12th of the month, the preliminary University of Michigan consumer sentiment for November. On the monetary front, we note that there are planned speeches of Fed officials through the week, which could also influence the market's opinion. And as for a more fundamental view regarding the international political scene, there seems to be some easing in the tensions of the US-Sino relationships, which if intensified, could lead to some safe haven outflows for the US dollar. Moving now to the pound, and this would be GBP USDs for our chart. Now the pound has been losing for the past week against the dollar, and we tend to maintain a bearish outlook given that the pair marks lower lows and lower highs. To the downside, we would note the 1.3430 support line. Lower than that would be the 1.3290, and even lower the 1.3185. To the upside, we note the 1.36 level, which was practically a support line and was broken, hence turned into resistance. Higher than that would be the 1.3750 and even higher the 1.3875. Moving now to the pound's fundamentals. The pound is about to end the week low against the USD this week, and BOE's interest rate decision practically sealed that course. The bank, in a hotly debated decision, remained on hold, keeping its rates at a historical low of 0.10%. Disappointing pound traders expecting a 25 basis point rate hike. In its interest rate decision, the bank mentioned that it expects inflation to rise and reach 5% year on year, and that's in spring next year. Yet also mentioned that it expects to ease afterwards. Nevertheless, the bank recognized the need to raise rates modestly to return inflation back to the bank's target of 2%. It also noted that the outlook has now changed and that the UK economy is recovering, unemployment has fallen, and that it expects inflation to rise further. It should be noted that the decision was reached by a majority of 7-2, while the bank also voted 6-3 to maintain its current asset purchases program at £895 billion in total. On a fundamental level, we still maintain our worries for the recovery of the UK economy and thus highlight the release of the UK GDP rates for September and quarter 3 on Thursday the 11th of November. It should be noted that on the same day we also get UK's manufacturing output for September as well, leaving the GBP calendar pretty light for the rest of the week. Sorry, ladies and gentlemen. Now, as the next pair would be JPY, and this would be USD JPYs for our chart. We tend to maintain a bias for a sideways motion as the pair has been moving in that direction practically since around the 19th to 20th of October. We highlight as a resistance line the 114.45, which was tested a couple of times. Higher than that would be the 115.20 and even higher the 116. To the downside, we note the 113.70, even lower we note the 112.90, and the lowest level noted in this chart would be the 112, which used to be a resistance line, and as it was broken later on, has turned now to a support line. Moving now to JPY's fundamentals. JPY seems to be strengthening against the USD for the current week. However, the sideways motion is still present, and quite so. At last Sunday's elections, Japan's ruling party LDP scored an unexpected comfortable election victory, which dismissed worries for the possibility of political instability and tended to weaken the JPY against the USD on Monday's opening. Now, the big question which is being posed in Japanese politics is if and how Japan's PM Kishida is to deliver his promised new capitalism. Fundamentally, and on other news, it should be noted that Japan's Trade Minister, Hagiuda, has asked the US to abolish the extra tariffs on steel and aluminum imports from Japan in a meeting with Washington's trade representative, as was reported by Reuters. Should the additional US tariffs to Japanese exports of steel products be abolished, we could prove beneficial for the Japanese economy. Yet, given the supply shortages currently tormenting its manufacturing sector, especially semiconductors, we may see exports finding a hard time increasing. On the monetary front, at a meeting of the Japanese government and BOJ, Japanese policymakers reaffirmed their commitment to the bank's 2% inflation target, which implies a continuance of the bank's ultra-loose monetary policy. Please note that the summary of opinions for the bank's October meeting is due out on Tuesday and could prove to be an interesting read. Fundamentally, we continue to expect JPY to be influenced as a safe haven in the coming week, as well as and depending on the market mood. As for the financial releases, we note the release of September's current account balance on Tuesday, the 9th of November, while on Thursday, the 11th, we get from Japan the corporate goods prices growth rate for October. Moving now to the common currency, and this would be Euro USDs for our chart. In a sideways movement this week between the 1.1615 and the 1.1520, we tend to maintain this bias for a sideways movement of the pair. And we note to the downside the 1.1520, which was tested practically around the 10th to 11th of October. Lower than that would be the 1.1445 and even lower the 1.1370. To the upside, we would note the 1.1615, which was tested 2 days ago. Higher than that would be the 1.1685, and the highest level noted would be the 1.1780. Moving now to the common currencies fundamentals, the euro seems to be pretty stable against the USD for the week, as these lines are written. Now it seems that the common currency has resisted so far the strengthening of the USD, yet the ECB's dovishness could start to weigh. It's characteristic that the ECB president pushed back against the idea of hiking rates in 2022 once again yesterday by stating that it's very unlikely. The bank tends to maintain the view that inflationary pressures are temporary. Also, ECB officials had underscored how market expectations are out of sync with banks' forward guidance. Other than that, and on a fundamental level, we note the energy crunch, which could slow the recovery of the European economy, as well as the supply shortages, which could weaken economic activity, especially in the manufacturing sector. Also, any possible escalation in the tensions of EU-UK relationships could affect the common currency. As for financial releases, we note on Monday the forward-looking Sendix index for November, and on Tuesdays Germany's trade data for September, as well as France's current account balance for the same month. On Wednesday, we get Germany's CEF indicators for November and Germany's final HICP rate for October. Finally, on Friday, we get Eurozone's industrial production growth rate for September. Moving now to the Aussie, and this would be AUD USDs for our chart, and a clear downward trend line guiding the pair. We tend to maintain a bearish outlook for it. Actually, the pair's movement could be providing with the clearest direction among the majors. So, to the downside, we tend to note the 0.7365, which used to be a resistance line and now is turned into support. Lower than that would be the 0.7310, also used to be a resistance line and has turned to support. And the lowest level noted would be the 0.7230, which supported the pair's price action a couple of months. That was near the last days of September. To the upside, we note the 0.7420, which proved its worth as a resistance line around mid-October. Higher than that would be the 0.7475, and the highest level noted would be the 0.7550, once again proving its worth around the 28th to 29th of October. Moving now to the Aussie's fundamentals, the Aussie seems about to have the widest drop for the past 10 weeks against the USD, ending its winning streak of the past 6 weeks. The move cannot be unbundled by RBA's interest rate decision on Tuesday, as the bank remained on hold as was expected, yet maintained a dovish tone regarding the timing of its next rate hikes. In Governor Lowe's statement, the bank acknowledged an acceleration of inflation, yet at the same time also mentioned that it is still at low levels. It also mentioned that inflationary pressures were boosted by higher prices for homes and a rise in petrol prices, while it expects only a gradual pickup in underlying inflation. The bank also announced that it will not increase the cash rate until actual inflation is sustainably within the 2 to 3% range, and implied that such conditions could be achieved at the end of 2023 and beyond. On a fundamental level, the pace of the recovery of the global economy along with international trading conditions could affect the Aussie, Also, the prices of raw materials such as iron ore and copper could also affect the commodities currencies directions. As for financial releases, we note that Aussie traders are to have an early start, as on Sunday China's trading data for October are due out, and Australian exporters of raw materials may have their eye fixed on the import growth rate. As also from China, we note the release of the inflationary pressures for October on Wednesday. From Australia, we highlight the release of the employment data for October on Thursday, while on a second note, we would also mention the release of the business conditions and business confidence indicator for October on Tuesday. Moving now to the Canadian dollar, and this would be USD CADs for our chart. Note how the pair has been in an upswing practically since the last days of October, around the 26th to the 27th of October. And that continues as the pair practically prints higher highs and higher lows. So as long as the pair remains above the upward trend line, we tend to maintain a bullish outlook for it. And we note to the upside the 1.25, which proved its worth. Also the 1.2580, which used to be a support line and has now turned into resistance, and higher than that would be the 1.2660. To the downside, we note the 1.2425, which was a support and resistance line, and lower than that the 1.2330, proving its worth around the 28th of October most notably. Even lower than that would be the 1.2250. Moving now to the CAD's fundamentals. The CAD seems to be intensifying its slide against the USD today, yet we note that both the US and Canada's employment data are still to be released and could affect the pair's direction. Given that in the coming week no major financial releases are due out from Canada, we expect fundamentals as well as the direction of oil prices to affect the loonie. Oil prices have been weakening for 3 days in a row and tended to instigate similar bearish tendencies for the CAD as well. On the one hand, the buildup of US oil inventories, as reported by AP and EIA, seemed to weaken oil prices. Yet on the other, the announcement by OPEC that it will resist calls from the US to increase production levels and stick to their agreed oil production quantities may cause oil bears to think twice before advancing further. Also, the EU-Iran nuclear deal talks are to start at the end of the month, and a positive outcome could open the taps of Iranian oil production, yet that seems to be still a long way off. On the monetary front, we note BOC Governor Tiff Macklem's speech on Wednesday, and should he underscore BOC's hawkish approach, we may see the CAD gaining somewhat. Other than that, a general positive risk-on attitude by the markets could also support the commodity currency. Now, as a general comment, we tend to expect the USD to allow for some of the initiative to be placed on other currencies, given the gravity and frequency of financial releases and monetary events scheduled seems to be more balanced. We would also make a note on the dovishness shared by a number of high-profile banks such as ECB, BOE, RBA and the Fed. The narrative used seems to be pretty similar, with expectations for inflation to rise, yet to be of temporary nature. On the other hand, though, their actions seem to vary, which could create interest rate differentials. It's characteristic that the Fed already announced the tapering of its QE program, yet seems to refrain from hiking rates earlier. The BOE, on the other hand, remained on hold, yet has recognized the need for rate hikes, even moderated ones. On the other hand, the ECB seems to remain firmly dovish, while RBA refused to hike rates. As for gold, we note that the negative correlation with the USD seems to have been interrupted. The drop of US yields seems to have allowed for the USD and gold prices to rise simultaneously for the week. Hence, should US yields continue to drop in the coming week, that could spur gold bulls, yet that remains to be seen. From all of us here at IronFX, best wishes for solid trading.